Have you ever wondered if you understand the best tax strategies when taking TSP withdrawals? If so, stay tuned for the next episode of All About FERS. Hi, I'm John Raleigh, certified financial planner with All About FERS, and today we're going to look at the best tax strategies when taking TSP withdrawals. As a federal employee, your TSP is probably your largest investment asset. You understand what it means to add money every single pay period, and how that money gets invested in your traditional or Roth TSP. Taking money out in retirement can be more complicated, and especially because you have to understand how the money is taxed. I like to say you're transitioning from a retirement saver to a retirement spender when you reach retirement. The first thing you have to understand is the consequences of your TSP. If you have a traditional TSP, the money was deposited in a tax-deferred account, meaning you receive a tax deduction when it's deposited. The money grows tax-deferred. When you withdraw the money, that withdrawal is taxable to you. If you have a Roth TSP, the money you deposit is after-tax dollars, so you receive no tax deduction when the money's deposited. The money grows tax-deferred, and as long as you follow the Roth rules, the money will grow and come out tax-free to you. Next, you have to look at all your sources of income. This may include your pension, Social Security, traditional and Roth TSP withdrawals, retirement income. The list can go on and on. Once you know where your taxable income is coming from, you need to find the tax bracket that you're in. We have a graduated and sometimes called progressive tax system, where your taxes start at 0% and work their way all the way up to 37%, which is our top tax bracket. This is how a lot of individuals get confused. And to add to the confusion, you have to learn terms, taxable income, capital gains, and understand they're taxed very differently. You also have to pay attention to your Social Security, which is included in your taxable income, starting at a 0% rate, and will go up all the way up to 85% of your Social Security included in your taxable income. There is an old adage, I've heard it more times than I like to hear it from the accounting fields, and that's the more money you make, the more money you pay in taxes. Now, if you understand where your income's coming from, that won't necessarily be the case. So what are some of the things you can do to help moderate your taxes in retirement? First thing to do is understand the tax status of your accounts and if you'll be taxed on the withdrawals from those accounts. This way, you're not surprised when you buy your dream car, your dream boat, your RV, a second home, and you pay cash for it out of your taxable accounts. And then at the end of the year, when you file your taxes, you receive another surprise of up to possibly 35% that you have to pay in addition. And that payment goes to the IRS for the taxes on how you withdrew the money. Pay attention to your income and how it's taxed. Now, I know you were hoping that we were done at this point, but to quote another phrase you hear a lot, not so fast. When you reach 65 and older, you're enrolled in Medicare. You start paying Medicare Part B premiums. And yes, Medicare Part B premiums are income-based. This is the point where you'd learn a term that you probably hadn't heard before, and that's MAGI, Modified Adjusted Gross Income. This is a special calculation you need to make that includes all sources of income, a lot of the other ones that you wouldn't expect. And that figure then is put into the income tax brackets, but for the MAGI calculations, with higher income levels, you pay significantly higher monthly premiums on your Medicare. So what are the takeaways from this? Try to avoid big withdrawals from tax-deferred accounts like the traditional TSP, IRAs, those sort of investments in one tax year. If you can, spread them over 2 or 3 tax years, and this will help reduce your tax liability. Next, pay very close attention to Medicare Part B limits to help reduce increases in your healthcare costs in retirement. It's not how much money you have saved. It's how much money you get to keep. Understand the rules, or at least having support from professionals that can help you navigate through the rules, should mean you'll keep more of the money you saved to fund your retirement. I hope this gives you some insight about transitioning from retirement saver to retirement spender. Your TSP withdrawals are a powerful tool to help you have a successful retirement. Thanks for stopping by All About FERS, and until next time, happy planning.